Hey! Hey!
Hashtag GizzyCredit. Hashtag GizzyCredit.
Gizzy.
GizzyCredit.
What's good, my people?
Don't be scammed, cause then you'll regret it. GizzyCredit. Anything you want, then you can
Let's go. Let's go live on YouTube, on Facebook. Oh, I'm already live. How you doing, my people? Hey, how we doing? We're live on YouTube, Facebook. Thank you for liking the video. Please don't forget to like and share the video if you like the content. Yes, sir. Yes, ma'ams. How you doing? You know what I got here? Got the cafecito. Let's talk, let's talk. This is what I love to do. I can't believe that happened. Italian S cookies. I just messed this up right now. I'm live. I'm a rookie. I always do my coffee demonstration every time I go live. One of the few times that I'm going live on my Facebook business. I'm gonna start going live on Facebook business because it works better for the algorithm for Facebook and for the business. And of course, can't go wrong with just being on YouTube with you guys. So we're gonna get this right, clear and quick. We're gonna, if you guys have questions, you can ask them on the comment box. If you guys got questions on Facebook, ask them on the comment box. You know, these podcasts have been popular because of the education that we have, but definitely this is good for all of us to understand how credit works. And now we are going to call John. Hold on. Oh, let me hear if you guys hear John.
Hello.
John.
Yes.
How you doing?
Good. How are you?
Good. Busy day?
Yeah, for the most part.
For the most part. Normally we get busy during like holiday weekends, because if you're not out there having fun, spending money, you're on YouTube watching videos and calling us. So how's Philly?
It's a lot different than Florida, man. I'll tell you that much. I mean, it's totally. I mean, it's about 6 weeks behind up here.
6 weeks behind.
Yeah, I would say 4 to 6 weeks behind relative.
That's a long time. That's a long time, John.
Yeah, I mean, down there it's much more open, and even before they actually physically verbally and definitively announced it, it was. I mean, I'm walking. My place is in Center City in Rittenhouse, and we got here Saturday, and I mean, there's nothing open. I mean, we're at the center of the city of Philadelphia, and there's nothing open. I mean, that's crazy. I've never seen anything like this before. I mean, ever.
I thought you had family that told you how things are in Philly.
I mean, they did, but I mean, it's all relative to the area you're living in, right? So what I thought we were experiencing down there in Florida was nothing compared to what's going on. I'm not laughing, but it's nothing. I mean, this is a whole different level.
Oh yes.
Of shutdown. You know, I mean, literally, you walk down the street. I've been living in the city of Philadelphia almost my entire life, right?
Yeah, you're from Philly. You're a Philly kid.
I mean, I went to college here. I've been living down here, and obviously now I go back and forth. But at the same time, I have never seen anything like this ever. It's crazy. I mean, there's nothing open. Literally nothing open. think they thrive in the situation. Like they got Dunkin' Donuts close.
Nah, Dunkin' Donuts in Jersey. I'm in Bergen County. I'm the beginning of Bergen County. We have Dunkin' Donuts are open. Even the drive.
But that's what I'm saying. That's the extent of what's going on. I mean, literally, there's Dunkin' Donut. There's like one Dunkin' Donuts in the whole zip code open. I mean, like literally, you got to walk like 10 blocks to get to the Dunkin' Donuts. I mean, there's like 5 in between there. So
wait till you start going to the ShopRite or Stop and Shop. Line to get in. You can't go anywhere without a mask. It's crazy.
No, you definitely the mask thing is way different up there. I mean, you got to wear masks down there, but I mean, people wear them walking around outside. I mean, it's just a different vibe. I mean, look, Florida's different anyway, but at the same time, this seems
like I have said before, Jay.
Yeah, it's different.
No. Also, isn't your governor a Republican?
Oh, sure, yeah, absolutely.
And over here we got this governor, Murphy.
No, I mean, typically speaking, around here, it's Florida or Philadelphia's always Democrat. It's been Democrat like 100% of the time. Maybe one time a Republican more, but the state of Pennsylvania isn't always just straight, Democrat. So
correct.
I know Jersey's is. I know obviously New York is. So I mean, it explains the strictness there. And look, I definitely appreciate the conservative nature of it, but I'm looking around and I'm seeing a functioning economy down there, right? Like the crazy thing to me is that down there, even when restaurants were closed, they at least did like pickup and takeout. You know what I mean? Like you didn't make them close. Like I'm looking out my window right now and I see tons of restaurants just on the one block. It's literally only they don't takeout, nobody there.
Yeah, there's nobody there, Jay. It's crazy.
Yeah, I mean they got like Sephora down here, which is down here is boarded up. I mean, you look in windows and there's just boxes and boxes and boxes of crap. Like somebody hasn't been there in months, and they're supposed to open back up here on June 5th. So I don't know how that plays out. I mean.
Well, that's the thing that I said to you about the. Remember, I asked you a couple of weeks during the Rona, and I know your perspective is different because you're open down there, and you see more things are opening up, like the economy. Yeah, it's whatever. I mean, it's something restrictions, but at least it's still going on. I want to know if in a couple of days your opinion is going to change once you see Philly, Jersey, or I don't know if you watch it on the internet or the news.
You mean as far as my interpretation of on how it reopens?
Yes, and the economy going, housing and all that stuff moving forward.
I mean, well, listen, all this is done is reinstill my opinion on that, right? I mean, this is crazy up here. This is crazy. I mean, there's no activity. I mean, there's absolutely no activity down here. Nothing. There's nothing. I mean, a lot of state economies have opened back up, and they're pretty much pushing to the last second, right? Here they're pushing till June 5th, which obviously they picked June 5th for a reason because you're getting to a threshold there where you're running into potentially a legal problem, right? If you don't open your state back up, they're missing revenues when other economies are flourishing, right? And then potentially there's no justification at that point. If it's not getting worse, and you're not doing anything in defense of the business, then the state starts running into a legal problem. So they're pushing it to the very last second to open back up. Right, wrong, or different, it's whatever. But obviously that's costing people money.
But do you think it's because also they want the government to step in and like bail the state out?
Do I think that's why they're? I don't. I think that this just sadly, I think there's some of this is politically charged and it's being massaged as they're doing it in the best interest. I think there is best interest at heart, but I do think there's some they're weighing on an extreme side of caution because of in some cases like a beyond extreme in the Democratic states because it's there's politics involved. I mean, unfortunately, this is politics. I mean, it just is what it is. Now they can't control the virus. If the virus spikes back up, then it is what it is. I just know that Trump already came out and said they're not shutting the government down again the second time. So they have to reopen and
Well, how long was the government shut down for? Like 2 weeks, right?
For our economy?
Yeah, remember? No, the government shut down the first time, like a year and a half ago.
I mean, I'm saying that literally they're not closing the economy. If there's
Okay.
another spike, see, where they're basing this off of is like the Spanish flu of 1918, right? So they're
Correct.
basing it off the idea that, they went through the summer months, and the summer months went great, a lot better, and things died down because of certain variables, and then after that, it spikes back up. And he came out last week and said, "Listen, we're not closing it. We're not doing the close down economy again. After if it spikes back up, we're going through it." So, I mean, it's effectively not leaving any open options as far as things opening, closing back down again. And that's why I'm saying that I don't know why. If that's the case, then I don't know what when I come up here, when I come from down there, and then I come up here, and it's like I said, it's at least 4 weeks behind, at least. At least. I mean, there's people not even coming out of their house. There's Memorial Day weekend, and I got here Saturday, and
all we see in the news up here is you people in Florida, Daytona Beach. No mask wearing, everybody's saying how you guys are the worst and this and that. I mean, you have your political affiliation there. They'll tell you guys are the worst, and then you got the other side telling you, yeah, go ahead, open up and go do your thing.
No, but here's the crazy thing, right? I've gotten, which is awesome. I've had a lot of clients since this all started reach out, be like, how's everything going? I hope everybody's all good, which I really appreciate, right? But
yes,
the thing I didn't understand is we don't get. So you guys get all that media up here about how Florida's, this, that, the other thing. It's terrible. The outbreaks are awful, blah blah blah. But look at the numbers.
Yeah.
Just look at the number. It's nowhere near the top. I think it's like 11th or 12th. And if you scale it out based upon its general size relative to the other larger states, because it's a large state in our country, it's right in line with the regular amount of consistent density of where it stands in the rest of the country. So it doesn't make any sense. It's almost like if you're not in that part, you can say it from a distance because there's no way to validate it. You understand what I mean? Well,
yes.
I'm down there, so I was saying I'm not seeing any extreme scenarios. I hear everybody calling the thing. The news is telling it. Good Morning America is saying it, right? But then when you're down, you're not seeing. When I come up here, this looks like a frozen. This looks like a frozen economy. I mean, this looks like
nothing is happening, John. Nothing is happening.
That's what I'm saying. Like this, when I came up, me and my wife anticipated that it was going to be slow up here, right? I anticipated it. It was the expectation. We actually came up a week early. We typically do because. And it'll give us time before it starts getting crazy down here and people start getting back, to situation. But I didn't think it was going to be like this. Like, this is like they opened the doors, and there's probably another month. Let's just say they open the doors the 5th of June. There's probably still another month before they get their act together, right? You can walk down the street. I mean, right on Walnut. It's the nicest street in Philly,
Yeah. You've got a whole bunch of Philly cheesesteak places there. Are they open?
Nothing's open. Nothing is open. There's like a handful of places open, and a handful of places are doing takeout and stuff. It's crazy, man. It's crazy. I mean, at least where I'm at right here. I can't speak for
No, but you're in downtown.
I'm right in the center of the city, so I can't speak for any of any of the boroughs and the neighborhoods. But I assume they're probably. I just didn't know, and I don't want to. I know we're talking about other things there, but I coming up here, I didn't think it was this frozen of a situation. So this was an eye-opener coming up here relative to there. And again, I think it's about a month behind. And I just think that's in line with the fact that you just see all these businesses that aren't even, there's not even banned. There's not, you can walk down the street and look in these restaurant windows just because they're not covering them, and you see boxes and stuff in there. Like somebody had been, like I said earlier, somebody had been there in weeks. Like they still got to come back in, get all their inventory. There's things that this has, that's going to take a month. So you're talking about that puts them into July, if they do open in the beginning of June, that puts you into July, mid-end of July. I mean, until you really start turning and burning and churning here. I can't even imagine what New York's going to be like. If Philly's like this, New York's probably worse. I can't even, Jersey, I mean, I know
No. In New Jersey, you see, we drive here, over here, Bergen County, even though it's the outbreak center, it's still, people are driving with masks on. If there's two people in the car, they both have masks, and they say it's to protect.
I see people working out with masks on.
Walking their dogs.
Working out with masks on. They're about to suffocate themselves. I don't even understand. I don't understand what exactly you're saving when you're just putting yourself at a health risk by running with a mask on, man. They're not meant for that. These are surgical masks.
Yes.
They're not exercise masks. I mean, it's crazy. It's crazy. I mean, it kind of takes me back to 6 weeks ago down there, like which would have put us right around the middle of March or beginning of April, and the perspective that was down there at that time. It's crazy. I mean,
no, you were gonna say the guy with the hazmat suit on, or the when there's like an oil spill, or like the big mask that has the airs on the side on the vents.
Yeah, I know what you're talking about.
Yeah.
You see people with them? I haven't seen anybody with that yet.
No, I thought when you said on the podcast that there was a guy, one of those on, walking into like a 7-Eleven.
You mean where they have like the painters things? Where they have
Yes, the painters. Yes.
Yeah. I mean, I saw that before, but I haven't seen that up here. I saw that once when I was in Florida, but I haven't seen that up here. Look, everybody thinks it's different. Again, as far as what I had said earlier about the economy opening back up, when we talked about 6, 7, 8 weeks ago, and how I feel prices are going to be and everything like that.
Yes.
It's not going to change, but we still haven't restarted fully yet, right? So it's, you can still see, like, they reported real estate numbers again last week, and they were down year over year, the most, who knows how long, and, you continue to look at other areas, asset prices, etc., and you say to yourself, and the repricing is going to go on, but it's not really going to take effect and really take shape until you start to see who's going to make it and who's not, because that's where.
Oh, okay. So it's still, how long ago from there?
Asset prices reset right now. Like, I'm looking around here, I talked about this last week, I'm already seeing drop 10, 15% for people that really need to sell. So you're already starting to see the repricing going on, but I'm talking on a large scale. You're not really going to see it until the pressure starts being applied. Now, the good thing that I did, I had a couple of those. I talked about these on our PPP podcast. I had a bunch of clients that I submitted for the the PPP and the disaster loans. They're finally starting to come through now. Now that
took about a month.
I literally closed one yesterday of all days for a client. He got $150,000. He wasn't even looking for that much. So they're giving a lot of money with the SBA loans, and with they're doing their job to try and get as much money, probably more than they probably need. Into the system, which I think is going to help through the summer. But I think that you're probably there's going to become a period of time where jobs aren't going to come back, and it just is what it is, and I think it can stay. I think with a lot of the liquidity they're pumping in, it's going to help, but it's going to help. It's going to help stay the scenario, right? So if you're a company that's not going to make it, all that's going to do is drag it out, right? It's just going to kick the can for you for a period of time, and eventually that money's going to get utilized. And if you're not turning a profit, you're going to run into the same problem. You're just dragging it out, right?
That's what I'm saying. So how is that going to happen? Because eventually people are going to look at things logically, or they're going to look at things emotionally, trying to stay a business that's going to stay open, that's been in business for such a long time, and now this happens, they weren't ready. Are they going to fully close, or are they going to hang on emotionally to it and take this loan?
I don't know. I mean, the good thing about the disaster loans is you don't pay. This is what I thought was actually really interesting. The one I helped the client close Sunday, you don't pay any interest for the first 12 months. They gave him $150,000, and they amortize it after that first year over 30 years. So they treat it like a mortgage. So this $150,000 he got, he's not paying anything the first year. You can pay it back with a penalty, and then the 13th month, he makes the first payment of like $720 or something, which is effectively it is a mortgage, because even a commercial mortgage only goes out 25 years, so you're actually getting a longer amortization than a commercial mortgage, but you're getting it in the name of the business, and you're getting it with effectively, the same collateral you're providing the same collateral. You're not giving them any property, you're not pledging it, but you as the individual is obviously guaranteed, so it needs to be paid. But the point I'm trying to make is, the terms are exceptional. I mean, that's a sustainable term for a company, right? I mean, $700 a month. I mean, you see people car payments more than that for a quarter of that amount.
Yes.
So for them to go out 30 years and do it that way and give them a year to do it, I mean, they did their job. It's just unfortunate that, you're talking about some people took two months to get it.
John, what do you think about manufactured homes? Because Carmelo is investing in that over there in Illinois, Indiana area.
What do you mean, like modular ones? The ones where they build them in a factory and they drop them in?
Correct. Well, you could drive it You could drive it to the.
Same idea. Yeah, that's like the future, though, right? A lot of the buildings you see, especially office buildings, especially the ones that look contemporary, that's how they're built. They come in, they're built in a factory, they're all roughed in and everything. They bring them in like, pieces, but they're already done up, right? So all the guys that come on there do is just connect them together. I mean, that's been going on since. The idea that's been going on for probably 10, 12 years is just now really starting to take shape because they realize because they've got the cost down back in the day, building that way.
But manufactured homes, I don't know if I'm trying to say trailer park homes, not trailer. People don't like it when they say trailer park homes. They like it when they say manufactured homes.
Oh, you're talking about more like okay. See, I was talking about how they build like houses now in general. You're talking about
trailer park.
Like I don't want to say trailer park.
I don't want to say trailer park either because it's not a trailer park.
Are you sure that's what he was talking about though?
No, he was saying that. Yes. Where you get a piece of land and you build these, and because of the economy being the way it is, that's what's going to be popular, is living in a place like that.
Well, listen, I think there's going to be a lot of adjustment, and I think it's going to take time. And nothing changes about what I said earlier. I mean, if you remember, I said going into the end of this year, into next year would be the right first quarter next year. I think will be a time when you'll be able to find some opportunity, or at least you'll start to get a much better idea of what areas are more affected than others, and what situations, who's going to survive, who's not, how's the economy going to respond to it, etc. One thing that's good, though, like I said, for the individual business person, and for the people maybe that are listening to this that didn't get their money yet, just be patient because it is coming through. It is slowly coming through, and the terms that are coming through are good, and they're moving it along quickly once you confirm who you are and you, they've approved your information already, it moves very, very quickly. So, that's the good news. I think that's going to help. Again, I think that's going to help kind of prolong some stuff, and if things can catch again, I think that's great. I think if you're somebody that's in the restaurant business, so the larger restaurant business, I think, along with obviously some other ones that are going to be directly impacted by this, I just think there's going to be a lot of shake out there, which is going to work its way around. The gig economy represents 50 million people in this country. It's like 15 to 18% of the total population. And the other thing I've noticed up here is that, and I didn't notice it down there, was the extent to which people are like programmed about.
Yes.
Every thought is based around how the coronavirus is going to impact them, right? So there's a lot of people that don't want to leave the house, more so than down there, right? And I'm sure every state's different, and I'm sure it's because...
Well, it's going to get hotter, Jay. Once it gets hot, once it starts warming up, you're not going to keep people inside. People are going to want to go out.
But listen, the people that came out this weekend and just ignored everything and are just riding out, those people had no intention of staying in anyway, right? They were pent up demand. They were allowed to go out. They went out. They said whatever. They're going to keep going out. They were the ones that haven't taken it seriously. So, but there's a large percentage of people, especially older people, and just people. It's just a lot of people that aren't comfortable with the idea. They're still very much, they're very much impacted by the scenario. And I don't even know if those people will be fixed if there's a vaccine. Like, I think that now it's just been imprinted in their brains, and that's how their brains operate now. And I think that we've all our large majority of the people in this country have become agoraphobes, and that's effectively how the thought process is, and germaphobes. And I think that's going to impact a lot of people going out and spending money, right?
Yes.
It just is. And couple that with the unemployment, where it is and where it's trending towards and where it's effectively going to go towards before it peaks. I mean, it's just not going to be it's great that the Fed and the government's doing everything they can, because I think it's the terms that they're doing it. The only mark I would knock them on is just how quickly they got it out. But in all fairness, these are typical SBA turnaround times. A typical SBA loan, I talked about this on the original one, even in a quick scenario, is 30, 45 days. These are closing in like 60 days. That's about right. So they just overpromised on the delivery of the funds. Quite honestly, that's all they did wrong. The terms are great. The amounts are far more than these people need. And, they couldn't make it any more accommodating. So, in that regard, I think they're doing enough to get enough money in the system to hopefully try and carry it over. I just think that, especially after coming up here and knowing how big of a market, how much impact New York, Philadelphia, New Jersey, a lot of these big Northeast states, and the amount of people that come with it, and they're huge contributors to the broader economy.
Yes.
And if there's a lot of indifference related to wanting to go out and spend and get out of your house and things like that, it's going to definitely tie back. And that's why I said earlier on, I said this a long time ago, but every area is going to be a little bit different, you know?
Yeah.
And how they get impacted by this when they open back up and stuff. Same with real estate, too. It happens in every situation. Back in 07, 08, you know, different markets were hit a lot worse than other markets, you know? And the same thing's going to happen here. It's just, hopefully it's not too bad. I just think it's still going to present buying opportunities for people that are going to be buying. And I certainly hope that, you know, the knock isn't bad. I do think there's going to have to be a mandatory repricing just because of what I've said before. I just think there just needs to be. Asset prices were too high for a long time, and as a result, you know, it forced just about everybody along the pecking order to over leverage. And, you know, now that we had a zig in the economy, you know, this is the fallout that typically occurs. There needs to be a resetting of asset prices, which will allow people to get in a much more sustainable situation, will help, you know, which will ultimately help reset prices, which gives more upside at the same time. So,
as an investor yourself, coming to the city that you invest in, do you feel like, you know, do you feel like you over here, you know, rubbing your hands, twirling your mustache?
Yeah, no, I understand your question. Not yet. I mean, I looked just because I looked to see, but it's not time yet. I mean, part of the I mean, I walk it like I talk it. So if I'm telling you guys a certain way that I think that's the way I'm doing it. You know, I'm not just telling people to do it that way, and I'm not doing it myself. I mean, I'm waiting for the right opportunities to present themselves. I just don't think we're there yet to where we found a bottom, in my personal opinion. But when you'll start to notice it, and like I've always said all the time, it'll start to present itself. You'll be able to see it, and you know, things will. There'll be a lot of other factors that come into play to get it there, but I'm always looking for opportunities. It's just there hasn't been a lot of opportunities relative to caps or just equity positions, you know, on long-term type stuff, or even mid-term, quite honestly, because there's just the prices here. Philadelphia's more of a stable market.
Okay.
Right? It moves more consistently and methodically. Some of the markets are more like commodity-driven, where they spike and then they dip, and then, you know, they move more like the stock market. Philly's more consistent. So even when they pull back, like in 08, 09, when it pulled back, the pullback was sustainable. You know, it wasn't like the pullback you saw in Arizona or Florida or Vegas.
Here's what's happening where in New Jersey, there was an article online. There's going to be a lot of New York City New Yorkers moving into New Jersey. And some people that work in the city, even if they move to New Jersey, they are still making money, even if they got to pay double tax from New Jersey tax and New York, and the state tax in New York State. They're going to be moving. Maybe that's what is driving prices up over here, John, where I keep saying to people that, you know, the realtors on my Facebook, they're like, I sold this house $25,000 over asking price, $40,000 over asking price, $70,000 over asking price. Maybe it's those people that are moving in that they see more value in, you know, a home. What do you think?
Yeah, I mean, look, there's a lot of marketing around real estate agents, right? Let's be honest. It's an entirely marketing-driven business, right? So, I mean, of course, they're going to make themselves look like they're doing a lot of business. Just look at the numbers. You can look up in that county how many houses sold in that month. Just do the math, and then look at the month of January and look at the difference. There's no markets thriving right now. I'm telling you, the last month, the month before, what month is it right now? April was the worst year-over-year decline in the history, I think, of our country. The month before was terrible too. So, I mean, I'm not saying there's still a market. You understand what I mean? That doesn't mean everybody's hiding under a rock. It just means that if you were operating 100% capacity in January, we're probably operating, I'll give you an example too. We're probably operating about 20% capacity right now. The guy from Delta came on last week, was on CNBC, and he said that on a typical day, now I understand the airlines are different, but it gives you an idea of the appetite. On a typical day, Delta is flying 500,000 passengers, okay, on an average day internationally. 500,000 people that they're flying in the air on any given day in a typical market, right? At the doldrums of April, they were flying 10,000 people. He said as of last week, they're enthusiastic because now they're flying 30,000 people, which is still like 6% of their normal 100% volume. So there's still a market that exists, sure, absolutely. But I mean, that market pales in comparison. I think it's great if somebody can buy over. I don't know why anybody sees this stuff right now, but different strokes for different folks. I got to tell you that the one thing that I'm getting from a lot of people, I've got calls from one of my close banking associates that works for one of the big banks that I deal with. He said he's moving down to Florida, and his wife are going down in June, and they're gonna get out. He's done paying taxes. They live in Connecticut, and he's getting rocked on taxes, and it just goes to show it's exemplary from what you're talking about with all the taxation. I mean, there gets a point in time where people, you make $1 million by the time you're done paying, the state of Connecticut, and then you have to pay the person, you pay all these the Fed, the state of Connecticut, all these different taxes. You're walking away with 60% of your money. Right, and the state of Connecticut is starting to jack up that that personal income tax as a way to offset other things, right? So you come down to Florida, all you pay is the Fed. That's it.
John, I don't know if you heard, but Joe Rogan just signed $100 million deal. Okay.
Spotify.
With Spotify. Okay.
Yeah.
So there's another guy on YouTube, Valuetainment. Forget his name, but he has a big channel too. He goes, Joe Rogan, you better leave California now before you get that money, before the state takes 13%, I think, of $100 million. That's like $13,000. 13.
That 100 is paid over a period of time, though, right?
But the guy said, because the guy's in Texas, he said, move to Texas or Florida because you're not going to get that much tax. Is that correct?
There is no personal income tax in Florida. None. Zero. There's not a situation where you ever pay personal income tax in Florida. So, for instance, in Pennsylvania, it's an additional 3.5% of your money, which isn't that bad. Some states are significantly higher. I'm fairly certain Jersey's a lot higher. I know Connecticut's higher. I'm pretty sure New York's higher. I know California's higher. A lot of the bigger states, are significantly higher. That's an additional. Do the math on that, though. When you don't pay that at all. I'm not even taking into consideration the accounting fees you're going to get every year for not having to pay your accountant to file it, but all over and above that, I mean, it's just people are coming down to Florida in chunks, man, because it's sunny all year round, and it helps Florida because Florida, the majority of their income, their state revenue is derived from tourism, right? So
correct. Yes. Yes.
So when you start to even that out, you start to get people coming down that aren't doing it just for tourism purposes. It helps them immensely because.
But I believe Florida is still expensive. Sometimes when I used to go to Florida and I used to go to the Publix, the sausage that's sold in Jersey for $4.99 in Publix was $5.50.
Well, I don't know what part of Florida you are. But
that was in Vero Beach, which is in the middle, the west.
No, I know where it is. And that's not a high cost living area, so I can't really explain why that would be. So I don't know. I can't explain the answer to that. But normally it's all relative cost of living areas, right?
Correct.
I know that, the cost of living in Southeast Florida, whether you go from, let's just say Jupiter down to Miami, right?
Yes.
I mean, there's the areas are very commiserate with suburban Northeast, right? I mean,
yes.
They really are. I mean, if you back out Palm Beach Island, Jupiter Island, parts of Miami, obviously, and, islands of Miami, I mean, they're a majority of the market is commiserate with nice suburban areas in the Northeast, right? I mean, it's really how it breaks down. It's not because honestly, Florida is a melting pot of people, right?
Yes.
You can find somebody down there in Florida that was born in Florida. It's like finding a diamond in the sand, man. I mean, it's
that doesn't happen.
Difficult. Most people have moved down there either at some point in their youth and just stay there, or they moved down for college and never left, or they moved down after and they never left, right? So. It's a situation where whoever said what you were describing earlier is absolutely right. State income tax is an enormous thing, and on $100 million over the course of time, knowing that. By the way, this is another point, and I know this is way off of what we put the top. You got to tie this in a minute.
Yes.
For the overall thing, but I mean, how do you think that all this stimulus money is getting paid for? Somebody's paying the stimulus money back, and that gets paid back through income taxes. Right now, the effective tax rate is 21%. They're already talking about having to raise that going into next year to start paying for some of this debt. So that's going to raise taxes everywhere.
Whoa.
And that's how we're going to have to start paying that money back. more money. I think it's great. Everybody looks at the fact that they're getting checks from the government and all this money's just peppering everywhere. But that has to get balanced, right? And yes, it works towards a deficit, but the purpose of government is to have to start paying back towards that. Somebody's going to assume that. And there's going to be a period of time, where you're going to see it might not be. I mean, they were talking about sometime next year. And they were also, they're desperately trying to roll back the SALT deduction, which is the real estate tax scenario that's hurting a lot of people in the Northeast, in the Democratic states, because the real estate taxes are high. They can only write off 10,000. But I'm just saying that you're gonna see real estate taxes. I mean, I'm sorry, you're gonna see like tax rates go up. It's inevitable. It's not if, it's when. I mean, maybe they don't do it in the middle of next year, but once the stimulus money stops, that's gonna be the point in time when they're like, okay, now we got to figure out how we're gonna pay. And there's only so many ways that a government can pay a deficit now. So 21% is going to be around long, but so you should enjoy it while it's here. But eventually that's going to need to start getting paid back, and when that starts getting paid back, that means areas, people are going to get taxed more than they already are, and then you're going to start to see areas like Florida become more and more and more attractive over the course of time, because even states are going to have to start balancing their budgets more, right? Because a lot of them took shortfalls as a result of this virus.
Yes.
How do you think they're going to make up their shortfalls?
In taxes.
I mean, sure, they can raise real estate taxes a little bit if they want, but that doesn't all go to the state. That goes to municipalities, schooling, etc. They're going to have to raise their tax rate. It's the only way that stuff gets paid back. So it's going to be a squeeze, and it's going to be a squeeze that's just going to drive people more to areas that don't have personal income tax. And Florida's obviously not the only one. It's just for the Northeast. It's, beautiful area. It's in close proximity, and it's nice. There's other parts, like you said, that other states in the country are just as nice that don't pay personal income tax, which are going to be just as beneficial to people going forward. So I mean, nothing about my perspective on the economy has changed whatsoever, not even a little bit, because but I do hope that it's a softer landing. You understand what I mean? I hope that it's because what ends up happening in any situation is we normalize, right, as an economy. So,
yes.
Like, the new norm effectively becomes the norm, right? It stops being the new norm, and it's just the norm. And then we live our everyday lives according to it. I mean, who would have known 3 months ago we're walking around with masks and all kinds of shit all over ourselves just to walk out the door?
Yo, Jay, there was I go to the BJ's. I got a BJ's here in East Rutherford, and the other day, the Saturday, there was a big line, and probably an hour, 15-minute line before you go into the BJ's. Man, I grabbed my car. I drove 25 minutes away to some town on Route 287. I got right in, no problem. Picked up whatever I had to pick up, and then came back home. I'd rather take a drive. I mean, it's crazy. Especially if you live in, like, I don't know how you're going to do it, because you're right in the center of it all. That's just like crazy congestion.
No, but that's what I'm trying to say. It's like a ghost town, man. Like, it really is. There's absolutely nothing going on down there. Nothing. I mean, there's nothing going on down there.
The scary part about Philly is that they said that they're not going to arrest people for petty crimes. So even if they rob you, they'll just like write your name down and they'll catch you later. That's the crazy part.
I mean, I'm not seeing anybody on the, I mean, look, there's people, almost understand me. I don't want to make it seem like it's just relative to a Memorial Day weekend in the past when the sun's out like it is today. I mean, it's like, it's nothing like it. And I get why it is, and I understand it all. I just didn't, it's a lot different than I'd say 4 or 6 weeks behind, which again, if it opens June 5th, you're talking about probably end of July till, you start to really kind of get things moving. If you give them time to open back up, get all the product in, get reset and stuff like that. And I can only imagine New York, which is much larger and much more intricate, will take just as long, if not longer, if they open at the same time. So, I mean, this is what I'm talking about relative to like it moving slowly, right?
Yes.
Because you don't know how they're going to reopen. You don't know if it's going to work. A lot of these places, or these places are going to open up only to last a couple months and have to shut their doors again, right? More jobs lost and stuff. So that's where the level of uncertainty goes, and that's why I always keep saying we're still at the doorstep. You know what I mean? This is literally the very early stages of something that is just shrouded in tremendous amounts of uncertainty. But listen, whatever the case, I do want to talk about what we entitled it, because I don't,
Well, this is what happens when No, people don't have any questions now. They wrote something on YouTube. But the topic today, sorry that we just started, but this is how it goes sometimes. You know, when you want to answer from John, it could take 40 minutes. 30. It's very detailed, and it's you know, he has to think about what he's going to talk about, so that's always good. Today's podcast is really supposed to be about a lot of the customers that we get, John. They have goals, and one of the goals is they want to purchase a new vehicle. They have a vehicle themselves where they thinking, oh, can I refinance, or should I trade it in, or should I just let it go and get a new one? You know, so but there's different because we have people that have high-end vehicles, and then we have people who just have vehicles that are about to, you know, just die, but they still owe $5,000, $10,000. So what are you gonna do? All right. So today's podcast is gonna be on that, refinancing or trading your car. You're understanding the numbers. So we're gonna talk about that. So yeah, John, the thumbnail picture is of a white Maserati two-door. And we actually have a customer that has a Maserati who is in this same situation. I'll let John talk about it right now.
Right. So, I mean, I don't know if he's the best scenario to utilize just because he has an additional option. But
well, we have another customer which we're gonna do an intake call with tomorrow from California, and they want to trade in their car, and I believe they owe about $10,000.
Yeah. So here's the problem, and this goes for. I'll talk about the original example, and then we can kind of walk it out. So,
okay.
The first client that that you're referring to had bought a Maserati, like I think it's 10 years old, right? He said it was 2010. And it was 10 years old, and he had, obviously, I think when he bought it, it was close to $100,000, and now he was like $25,000 on, but his payment's still about $1,200. He was asking, what are his options? He wanted to trade it in, but they were going to hose him on it, like most of the time they go to dealers. And he was like, well, maybe I can refinance. I said, well, what's the car worth? He said, well, look, trade in, it's telling me it's worth like 25, 24, 23.
Mm-hmm.
And I owe 26. He goes, but I don't mind bringing the cash to the table just to cover the difference, just to bring the payment down. And I'm saying to him that, look, the prime auto financing that you can get is typically on cars for 2015 up, right? As it stands now here in 2020. When you start going beyond that, it poses exponentially more risk to the lender themselves, right? The potential of the car breaking down with the acceleration on the depreciation of the vehicle every year that you own it becomes a problem. And quite honestly, the terms that go out on older cars are just, unless it's a buy here, pay here, you start getting put on higher interest the further, the older the car is and the further it goes out. So, I mean, we had suggested to him that maybe selling it privately in that particular instance would make the most sense because it was, Maseratis are, they're nice cars, and there's probably somebody that'll snag it and pay it off for him, and at that point he can pay it off. He doesn't have to come out of pocket. He doesn't have to get bent over by the dealer, only for the dealer to make the money that he would ultimately make selling it on his own, and then he can get out from underneath the payment because he didn't even really want the car anymore. Now, his situation isn't really the normal situation we get. The normal situation we get is more relating to the second scenario you gave, where somebody has a car that they're in at like 15, 16, 17, 18%. They got into the car. They were happy they got into the car, and after one payment, they realized it's just unsustainable, and they're unhappy immediately. Now, this isn't the client he's talking about has had this car at Gizzy. I think you said that they've had it for a while, right?
They had it for a while, and I got someone right now on YouTube that just said, "That's me. That's me. My car about to die. 5,400 left on the loan." So that's an old car. They still owe a lot of money on, and then. What can he do?
Right. So if it's somebody like the example that you're given, where they've had it since 2010, and there's only a couple possibilities in that situation. Chances are the car's not going to have the value that you need, and if it is, it's going to wash out. And the lenders only lend in most ideal situations. We talked about this before, 110% of the value of the car, right? But when you're getting into a car that's 10, 11 years old, and you're just trying to get out from underneath, you have to make the determination. Does it make more sense? Either A, privately sell it, B, try and trade it in, or see if the interest rate is right. Potentially, obviously, doing that. Now, sometimes what they do when the vehicle is older, and I would never advise this, but if the vehicle is older and you have equity, they'll do title loans, right? Where you can actually, take a loan out against the car if you need the liquidity, and they'll do it. It's much higher interest. I would never advise anybody to do it, but that's an option for people with really older cars, like 10 years old plus. If the value is there, if you actually have value in the vehicle relative to what it's worth, and it's utilizable. But in typical scenarios, for instance, we've talked about this before, just an average scenario where a client got into a car at 18, 17, 18, 19%. And let's just say, for argument's sake, it's a $30,000 car. Now, let's just say $25,000 car. If they've had it in the first couple of years, 85 to 90% of that payment is going to go towards interest. So on that $25,000 loan at 18%, the payment's going to be like $600. If you run it over 50, if you run over 60 payments, which is 5 years, you're talking about it's probably about 6 and change. Of that, close to 90% of that payment is going to go towards interest for the first 2 years. So the problem you run into in those first 2 years when your interest is that high is you don't get it paid down enough to build in the area, because in all fairness, you probably overpaid for it, which is what we always see. They overpay for the car, because what ends up happening is that dealer not only gets them on the rate, not only gets them on the price of the car, but they also roll in tax effective fees, which is understandable, but they bend them over on the trade-in, right? So they roll as much as they possibly can into that loan, so it's at 109.999%, and they can just fit it underneath. The problem is when you make 2 years of payments, only 10% of each payment is going towards the principal. You don't have paid down enough. After 2 years, you paid down literally, it appears as though it's nothing. Use that scenario, you pay 10% of that $600 payment, that's $60 a month times 12 months is $700 a year times 2 is $1,400, right? That really is coming off of principal, when in actuality you pay $14,000 in payments.
Wow.
Right?
Yes.
So if your balance was $25,000 and after 2 years you made payments, you're like, I want to go refi it. Your balance is $23 and change.
Yes.
So you made $14,000, $15,000 in payments. That may not get you to the point where you can refinance out. And in that situation, if it's too tight of a stranglehold on you, the best case scenario is for you to go in, obviously, and then do a trade-in, because unless you think you have equity in, but you would be able to have equity in, because if you did, you would be able to refinance it. So in that situation, which we see sometimes, the only option is to then take the negative equity in the car and trade it in and get a sustainable rate lower. So for instance, we talked about this before. Let's just say and in a lot of cases, the people that get these cars at 17, 18%, 19%, whatever, it's not necessarily the car they wanted. It was a car that they could work for them at the time. They got the flexible financing from the dealership, or at least what they deemed to be flexible, even though it really wasn't. And it allowed them the opportunity to get in the car. And then they ultimately end up presenting the car over the course of time, right? Because it's the payment, and any number of things causes them to resent it more and more and more. So a lot of times, by that period, when they want to refi it, it allows them an opportunity to revisit the idea if they even like the car at all. In that situation, what can happen is if we now clean the credit and get them in that position, and they can now qualify for an auto loan at, let's just say, for argument's sake, a prime rate like 2-3%, which happens all the time. Now, obviously, even if you roll, let's just say that car has $5,000 or $6,000 in negative equity, you roll that into the new loan, you're only paying 2 or 3%. So effectively, in that instance, 70-80% of your principal payment now is going to go all towards principal rather than interest, right? So in that same scenario, at $600 a month, over 2 years, you're going to pay, $12,700, $14,000, $15,000, and of that $15,000, about 12 is going to go towards principal. Well, in that same period, you would have paid off all the negative equity, and you would have paid down a lot on the principal, and you would be getting on the backside of the loan, right? So it allows you the opportunity when the interest rate is lower to accelerate each one of those payments towards principal, just by the way it's set up because of the lower interest. And allows you to pay off that negative equity quicker, which allows you to get in a prime position where you're not upside down, which it seems like almost every single person that gets a high interest loan perpetually and completely inadvertently gets put in, because because the interest is just, all the interest on any loan you take out from a lender is always front loaded. So it's heavy loaded on the front, and as a result of that situation, this is what happens. So, it really boils down to,
you really got to have good credit in order, if you get tired of the car a year or 2 years later.
Here's the thing. We talk about this all the time about how, knowledge the knowledge that people have and being able to exercise that knowledge, right? And
Yes.
we try to teach people and give people a lot of knowledge so they can make the right decision for themselves. This isn't a plug for everybody to do credit repair. If you're somebody that was taken advantage of and you got an 18% rate, in actuality, you should have been a 10 or 11% rate. That's a savings in and to itself. So maybe somebody following our advice and going and getting the financing on their own established and being able to chop that rate in half, that's going to save them an exponential amount of money, right?
Yes.
So in situations like that, that's going to alleviate them, and more of their payment's going to go towards principal. And obviously their payment's not going to be nearly as high either, you know, and that's going to save them, and maybe it's not going to be as much of a pressure situation. But I think, you know, obviously to do it right, you know, and to get the lowest rate and to be able to put them in a power position, a position of leverage, and not having to, you know, kind of deal in a subprime environment, obviously getting the credit clean and having ideal credit in order to get any kind of financing is obviously the best case scenario. Otherwise, you're going to be putting yourself, especially depending upon the amount of money you make, right? If you're somebody that's tight, you know, as far as all your bills, you're taking care of a lot of people, and there's just a lot of bills relative to what the gross, you know, the annual income is after taxes, then obviously it's a situation you really want to take into consideration, because if you're forced to have to leverage and spread your dollars thin, you want to be able to borrow at the best rate. It's the only way you're going to make it sustainable, because A, it's going to be the cheapest, but A, it's also B, C, and D going to allow you to spread it out evenly without strangling yourself, right? So somebody that makes the average, we talked about this previously a ton of times, average human being in January in this country, the average wage is like $55,000, right?
Yes.
And so, you know, you say after taxes, before taxes, that's like $4,400 a month gross. After taxes, depending on what that tax looks like, if you work for a company and if they're taking out for 401, etc.
Yes.
And you might get $3,000 to that. You know, you might get $2,600. It depends on the situation, right? So, I mean, you're talking about, after that's all said and done, you got to be able to, you know, between housing costs are not cheap as a result of asset values being high, right? So, I mean, housing costs are not cheap. So that's obviously the first one. Then the car loan, which is why we stress so much about people being aware of what their options are and how to really micromanage that and get the right financing. Yeah, that's the second biggest purchase. And then people level on the credit side too. So it's really important to do the credit, but if you can't, or if you're not allowed to, meaning like if your finances are inhibiting you from being able to, then having the knowledge is going to be your way to navigate, right? And that's why we do these, is so you can have the knowledge, you can have the understanding, and if I'm not being clear, we obviously answer the questions too, which allows the situation to maybe provide some clarification for if I'm not being absolutely clear with what I'm saying.
Well, right now, someone, Fatboy850 just says, never again subprime loans. And Curtis Davis just said, yes, that's how I got stuck. And he just finished, I'm giving away $9,000 for next 2 years, but now my credit is A1. Okay, good.
Which is good. So now you know how to go, you know what the next steps are going forward to not do it again, right? To not perpetuate the problem, to not perpetuate the cycle, to stay out of that cycle and be in control. Because in that kind of a situation, you now gain leverage, right? You know what you're doing, you know what you need to do, you know how you need to do it, and then that's for you to analyze, right? It's not like you walk in the dealership and take the one deal that the guy sitting across and tells you is a great deal, when in reality it's terrible, right? It's great for him because he's making a lot of money. He's got a smile on his face for a reason. You know you got a dealer in a bad position when the guy comes back to you reluctantly with an approval, okay? And the rate's good. You know when that guy's not coming back showing all his pearly whites, that you got them in a bad position. But in a lot of cases, you won't have that opportunity.
And a whole bunch of inquiries.
Yeah, I mean, we had somebody the other day that you know was getting started, you know, getting ready to get started, and they said the same thing. They went to get a car before, and they didn't think they were going to do it. They told the person to run it once, and they ran it a million times. It's the same story every time, and not that I don't think it's a legitimate story. It is a legitimate story. It's just how many times you got to get burned with the same story until you wise up, right?
So we have these customers. I believe they told me they owe $10,000, and the car is about to just die. So in this way, what do you do? Are they gonna, their credit? We're working on their credit, but let's say in 2 months we give them into a better position. What happens to that money? It goes into another loan with the new loan.
The car has to have some kind of value. So if they owe $10,000, the car has to have some value. It's not gonna be worth zero if they're driving it. You understand what I mean? Let's say it's worth $4,000.
Okay.
They owe 10. Just for argument's sake, I don't know what it's worth, but let's say it's worth 4 and they owe 10, which is not uncommon, especially if they paid through. I understand they've been paying on this card for like, what'd you say, like 7, 8, 9 years, something like that.
Something like that, yes.
So they probably refinanced it a couple times, which is why they have such a lump relative to what it's worth, because it depreciates faster than you pay it off at that point, right?
Okay.
I mean, it's just how it works. So in situations like that, what you would have to do is go and do the scenario I just explained before, which is that, you know, you find the car you want, we get them positioned at a low interest rate, 2-3% once the credit's done. They go in, they negotiate a trade-in value. They identify their car, they'll roll in the negative equity to the car into the new car loan. So in essence, it's going to be added on to the new car loan or included in the new car loan you take out. So let's say they're going to get themselves a new Toyota, and the sticker on the Toyota is $20,000, and you know the remove for Ford. You know, typically what happens is the dealer will have to cut back in some area to squeeze that in. They'll add the tax and title to fit it under that 110% or whatever that book value is on the car, and then they'll smooth it out. And the way they're going to get back on that is that the payment's probably going to be cheaper because the rate's low, but on top of that, over the course of the first 6 to 7 months, they'll pay all that negative equity back because the interest rate will be so low. You see what I mean?
Yes.
So from that 6th or 7th month on, it'll be all principal payments, and it'll be accelerated principal payments because they're not going to be paying 18, 19%. They're going to be paying 2, 3, 4%, right? Which, as I said earlier, puts you in a situation where 75, 80% of that payment, sometimes more, depending on how low the interest rate goes directly towards the principal. So besides it in that way, and it also allows them to pick the car they want, right? Rather than the car they can get into.
Oh, I get you. Yes. But you know what? Well, what's happening right now with the economy, with these banks doing a forbearance, is that right? A forbearance on the car loans?
Yeah, they got them everywhere.
How about these people don't get any jobs? I mean, come 90 days from now.
All you're doing now is arriving at what I was trying to explain earlier around the uncertainty, right?
Yes.
This is exactly the uncertainty why you're not seeing Chase Bank lend again on the business side for the rest of the year. Why you're seeing Amex cut back dramatically on the business side. You're seeing all these business lenders cut back retail businesses. I'm not talking about merchant cash advance companies or anything ridiculous like that, in my opinion, as far as sustainability. I'm talking about retail, traditional lenders that pepper our entire economy and help bolster our economy in slow, medium, and good times. They're cutting back on the business because there's just no clear vision. Now, your question is valid, right? Like, why would they lend if you don't know if these people are going to get jobs? Because that's how they make money. And there's a certain degree of risk. If you go back to our previous podcast, as it applies to auto loans and credit cards, they make a boatload of interest on them, right?
Yes.
In a lot of cases, because most people are in that, I would say the average interest rate that I see based on everybody I see on a daily basis is in the early single digits. So if you could say to yourself that, they keep that's an average return for them on their auto loan portfolio, that's pretty good, right? So they're gonna take a little more risk there because, the ability to get the car back and roll it off, it's not a long loss mitigation scenario for them to recoup, and they can continue to make money on it because the interest is higher and it's a collateralized risk. So that's why they're willing to do that. The reason why you're seeing it tighten up a little on the mortgage side and on the business side is because of the fact that, there's just, number one, the amounts are different. The loss mitigation is entirely different, and the government is forcing them to handle a lot of the lending pertaining to everything right now through the PPP stuff, and a lot of the business, analysts and lenders themselves are just completely inundated with work, right? More than they even know how to handle. So, to answer your original question, I that's why, because they're willing to take that risk because they know they have a certain graphic on the or benchmark on the risk that they'll expose on the auto loans. So they'll do it. So as a result of that, they have to keep turning paper. That's how banks make money, right? They make money off the interest. So they got to continue to turn paper. They got to lend it somewhere. In the areas that they already have elevated default risk is the areas that are going to keep doing it until there's a little more certainty, and then they'll probably open up the other areas. But who knows when that certainty presents itself, because it's not now.
Correct. I have someone here says, is it better to trade your car before it reaches 80,000 miles? So I'm thinking, how many years is that in my head? Because if you're averaging 15,000 miles a year,
it's 5 years.
That's 5 years. Correct.
But it's not always that black and white. I mean, there's other variables that come into play, right? So I mean, I don't know if that's necessarily I'm sure the intrinsic value of the actual vehicle with 80,000 miles on is whether it's 80,000 or 50,000 or 40,000, it all leans back to a certain value of the asset itself with those miles or without those miles on it, right? So, I mean, I don't think 80,000 miles is when you trade it, but most people don't have a choice, right?
Yes.
To trade the car when they have to trade the car in. So, and then there's a value associated with the car at that time. The ideal scenario would be if you can be, in the black on that, not in the red, as far as, you owing less than it's worth. And it being worth more than you owe, obviously. But that always.
So it doesn't matter if it's a car that holds its value, like a Lexus or Toyota.
Say that again.
It doesn't matter. Like it depends on the make. Like Lexus and Toyota, they preferably their value doesn't go that much down, or it does all car manufacturers.
Again, it's all relative though, right? I mean, it's if you get a car and you leave it in the garage the entire time, right? And it's a nice model, like something like you suggested, Lexus, whatever.
Yeah.
It's gonna hold its value. But any car, if you leave a Buick in the garage, and you don't drive it, you don't put any miles on it, there's not going to be the same amount of depreciation as another vehicle that you put, 50,000 miles in the first 2 years, right? So, I mean, depreciation is inevitable, and when it comes to autos, it's not something you can avoid. It's not the wear and tear associated with the miles and stuff puts pressure on the guts of it, right? But the depreciation as a whole, just from driving it off the lot, it occurs every year. So there's just you can't hide from the depreciation of it. So, I mean, you just have to factor it in. I mean, it's just, you can't control. I mean, if you're a salesman and you get reimbursed for your stuff, you're going to be running up miles everywhere on your car, right?
Oh,
and
that's true.
You're getting a tax advantage for that, or at least you were up until 18. And then the gas write-off, whatever the case may be, you're getting compensated back for that, and that's where all the miles are going. And you're going to do that because that's your job. If you're somebody that just travels a lot. See what I'm saying? Like, trying to measure miles is going to be very difficult if that's how you're arriving at your financial choice. I think it just makes more sense. I mean, obviously, if you're going to put 100,000 miles on a car in the first 3 years, you're going to put yourself in a really bad situation where it's going to aggressively depreciate, and it doesn't matter the kind of car you have, right? Because they're going to use that against you when you trade it in. But if you stay within a reasonable amount, I mean, you should really work more from the numbers than anything else, because you're going to get an average level of standard depreciation, and that's what they're going to factor in, and you're always going to be able to see what your car is worth going to, one of the, whether it's Blue Book or another one of them, to be able to kind of assess that. But, I mean, I would say, just because, and this is obviously case specific, but
okay,
when you take out any loan, you don't start, the inverse of the actual loan dynamic doesn't really start happening until after the second year, going to third year if it's a 5-year loan, where, the interest, the dynamic I was saying before, where the interest is front loaded on, the payments are front loaded with interest on the front side. When you start getting to the back side of an auto loan, assuming it's like 5 years or more, when you get on the back half of that, more of that starts going to principal, and you start accelerating that pay down, right? So if you don't beat it up too bad, and your interest rate is really low, and you get to the back side of that 5-year loan, you're at, the second, 2.5 years or roughly 30 payments, and you start paying, you're not putting as many or too many miles on it, you're going to really get out in front of that because of the fact that, you're accelerating the pay down on the back side of the loan. If you ride it out 5 years, more than likely, if you have a low interest rate, you're going to be, and you don't just ride it into the ground, turn it over a couple of times as far as miles, you're probably going to be all right and have some equity in the car when it's all said and done, just because the low interest rate, you have it all loaded off and you did it correctly, It's just how it is. The value will hold a certain degree of value. The car will hold a certain degree of value into that period, and as long as your interest rate's low and you make all the payments and you don't refinance it, which will drag out the term and all that stuff, you should be in a relatively reasonably good situation. That's why it's so important to be able to get a sustainable rate on these auto loans.
Correct.
That doesn't always mean it needs to be 2, 3, 4%. I think even in the higher single digits, like 6, 7, 8, I still think that's a reasonable interest rate. It's not great, you get it down, but it pales in comparison to, obviously 17, 18, 19, 20%, which some people are getting. That's just insane. And that's not even sustainable on anybody's budget, right?
Yeah, remember Raphael? They moved to and his wife, they moved to. He's a truck driver. They moved to Pennsylvania. Anyways, they were gonna get a car, and she was gonna get like a 4.6%, but I guess they wanted more documentation, so they just went to the dealership. They ended up getting a 6%, because they went online and applied, and they were approved for a 4 point something percent. But then they were asking for too much documentation, so they just said, "Let me just go do it, at a car dealership where they're gonna play around with numbers." And she ended up getting a 6% interest loan. But John, this is all like personal, right? Personal financing, where it pertains to credit scores. What's gonna happen? This is an economy question. What's gonna happen, because these car manufacturers, these car dealerships, nothing is moving. On top of that, you got people. Hertz, Avis, they went bankrupt. So what's gonna happen to those cars?
Hertz has. Avis hasn't, but Hertz has.
Okay, so Hertz, and they have a whole fleet of vehicles.
Right.
What happens then? Because those vehicles aren't being, driven. Values are going down because it's.
Well, those cars are actually the collateral where they lent all the money, right? So they're actually pieces of collateral that will get worked out with whatever the bankruptcy restructuring happens, right? So for right now, they're going to sit in limbo. And if you're asking if somehow that supply of cars is going to affect the overall demand,
yes,
or if it's going to somehow affect prices as a result of them trying to sell them all for something,
correct.
There's so many cars that sell even in a slow market. I'm not sure that that's going to put a whole big lot of a dent into it. I do think though that you're right about the fact that a lot of dealers are really aggressively still trying to move product as they should, right? And,
yes.
I think that things will start to loosen up for them over the course of the next couple of months. I still think it's going to be. I think they got a lot of pent up inventory that hasn't sold over the last couple of months, so they're going to take a couple months to catch up. And who knows if that gets them out in front or if they're just playing catch up for the previous slow months. I think that that's going to obviously lean all the way back. And I think we talked about this before. You're starting to see it now where, like, actual manufacturers themselves are coming out with these terms now, financing terms. Now, keep in mind, we talked about this before. Most of the time, 95% of the time, Lexus Financial, BMW Financial,
leases.
Anything financial that has a manufacturer's name on it is all for leasing, right? Because it's them, the manufacturer, that you're effectively renting the car from them. You're paying them, so they'll, that's the terms that you're going to make the payment because you're renting the car from them effectively by leasing it over a period of time, and that's you're going to make a payment to. There's no intermediary there, right? Well, in certain instances, when you hit economic slowdowns, you saw this with 08. You're seeing it again now. Companies like Ford, and Ford, it's actually FNB Omaha Financing, which is Ford National Bank. You'll start to see. Them come out with their own financing packages. Like right now, Ford's offering, I don't know, it's like 0% for 2 years, no payments for 3 or 6 months. You're starting to see a lot of them come out with that to motivate people to come out and actually start buying, right? Because
yes.
The terms are effectively just free money and allows them to move product. Because they can't hold on to product. They can't make money with it. It's already tough enough to make money in the auto business to begin with. When they're holding on to inventory, they have to figure out ways to get rid of inventory. And they're like any other kind of retail bank, right? They
yes.
have to get rid of inventory. In order to do that, they have to take extraordinary measures. Obviously, this is an extraordinary measure, right? When you start seeing these kinds of terms present themselves. And it should give people a pretty good idea of what their expectation is. When they come out this early in the game and they're offering these kinds of terms, that's an effort to get out in front of a situation they see may continue to stagnate. So you are seeing a lot of opportunity there to make, if you have a certain credit requirement, they'll allow you all these like ridiculous terms that they're offering as far as keeping the payments down, paying no interest, keeping the price of the car down. So they're doing everything they can on their end to do that and trying to make it as accommodating as humanly possible for the consumer. For somebody that doesn't have prime credit or doesn't have a relatively clean file, it's not as easy for them, right? They run into the same traditional scenario, which ultimately leads us back to this conversation.
Yes. Over here, Christopher Williams asks, is it better to buy a car around Christmas time because they're given all types of incentives, or is it the worst time to buy?
I think the incentives you're going to get right now, they'll probably, I don't know how they could get any better, and they'll probably stay in form. I don't know about the time of year. I mean, anytime you see dealers running promotions, they're running because their expectation is that they're not going to sell a lot of cars, right? So I can't imagine Christmas is a busy car selling period. I may be wrong. I don't hear a lot of people talk about it. I also don't see an overwhelming amount of promotions at Christmas any more than I would see at other times of the year. So I do think, though, the promotions you're seeing right now across the board are probably going to be in effect for a rather significant period of time in order until there's some clearing and certainty that exists where they can try to make sense out of if they expect the demand to either lessen, increase, etc., and then you'll start to see them make continual adjustments going forward. And I don't know what more that they could possibly adjust. I mean, when you're offering 0% interest for 2 years on an auto loan, and again, this is a general scenario. They may have gotten even more aggressive than this, but 2 years, no interest, no payments for 6 months. I mean, you're effectively driving the car off the lot. You don't have to make a payment for like half a year.
That's crazy to me because what's going to happen with insurance?
Well, the insurance doesn't have anything to do with the payment, though, of the car. So the car is still in your name. It'll still be the same process for insurance.
So you're still walking out paying insurance month to month?
Yeah, because you're still getting the car in your name. Everything else is the same. You're just not making any payments on it, which is insane. It makes absolutely no sense. And I don't even know how, if you're the financing institution, how or where you're finding where the money's to be made there. I can't quite figure that out because I don't think there's an answer to that. I think it may just be a matter of trying to squeeze out some kind of return on the interest side if you're not making it on the actual equity on the sale of the car at that point. You're figuring out just an alternative way to book profit. But either way, it's not going to change the actual transaction process of taking ownership of the vehicle, and our insurance needs to be in place and everything like that. That's going to be the same whether you got to make a payment or not. Just imagine if it ends up being a year, no payments, no interest for, let's just say 3 years. That's crazy. That's crazy. I mean, 6 months no payments and 2 months of no interest, or 2 years no interest is crazy. It's only going to get more aggressive if it continues to be a tight market. So I mean, they still got to move product, man. It's a major contributor to our GDP. It's a major contributor to our broader economy, and obviously people need to buy them. So see what happens.
I have Marvin, who is a customer from California. He started shipping like personal products from California to the Philippines. He doesn't want to create a business because it's more of a personal thing, but he's actually reselling over there in the Philippines. He wanted to get a higher limit credit card, but then again he said, but then if I ask John's going to tell me, well, wasn't the most important thing for you to get a mortgage? And that's when I said, well, that is true. What is it?
That's very true.
So what is it? But he still wanted some advice. It's like some people, Jay, they just want you to give them, because a lot of times for the people who are watching, people come to us and we're like your personal finance manager. Like, we'll tell you when you're ready to do what you want to do, as long as you tell us your goal that you want to do. So if your goal is to get a mortgage, but during the time that we're fixing your credit, your goal starts to change. Your goals start to say, hey, can I get a credit card? Can I get a new vehicle? At the end of the day, we got to go and take you to that main goal, which for them is to get a house.
But bear in mind, the reason why I go back in a lot of cases when the individual's initial focus and primary goal is the house is because of the fact that any new debt you take on backs into your debt-to-income ratio and pressures your ratio. So you're effectively, relative to how much new debt you're taking on and what that subsequent payment is, that's impacting the amount of money that you can borrow, right? Or the loan amount of the house you can borrow. That's why I'm so aware of it and conscious of it. Now, opening up a high-limit card isn't the end of the world, because even if it's, you get a $15,000, $20,000 card, if you fully extend it, it's $500. That can be a problem, right? Obviously, depending on how tight you are on your debt-to-income ratio. So if it was something like that, and they were planning on and they were planning on using it up and paying it back right away, more like a charge card, then maybe. But I tried to do it in a way just to make sure that we get the goals hit, and the ones that are the largest priority, knocking them out first. Because after that, then the pressure is off of them because they're in the house, they're more comfortable, they can see clear, and then we can start knocking out the other goals. I do understand, though, and we've dealt with this forever, that there's some audibles I call throughout the process, right? That's
Yes.
just how it is. You work around it, and it's like anything else in life, and you try to kind of give them the best advice in the best scenario. So if there's a business that's got that Marvin's got that he needs to raise money for, and if he's ready for it, we can go try. As long as he understands, and this is what I'm always clear about, because I try to be crystal clear about everything.
Yes.
So there's absolutely no confusion now communicating it. That's why you get 15-minute answers to a question that I could just answer with 3 words. Is the fact that, if you know that you're running that card up and it's 20 grand and you max it out, and that's going to pressure you effectively, not only is it going to drop your scores because it's going to raise your unsecured credit ratio, which is effectively going to drop your scores, which we talked about in the last podcast, but then that $500 is going to count against your debt income ratio, which at 3.5% could potentially cost you $150,000 in buying power.
Yes.
As long as you're okay with that, then I'm fine helping to facilitate it and help guide you in that direction. I just want to make sure that everybody understands all parts of the game, and then if they make the decision at that point, then yeah, sure, I'll help you out. But a lot of times what ends up happening is we go through this conversation and they're like, forget it, I'll wait. Because they don't want to run the risk, right? Because they know when they look at it from a broad perspective and they understand all the pieces, that they don't want to run the risk of potentially overusing it and compromising $150,000 in buying power, because $150,000 in buying power is it's the difference between 2 different neighborhoods, right?
Correct.
The difference between 2 different school districts. That could be the difference between a smile on your face and, okay, I just got this house.
And he's over there by what do you call the Silicon Valley, San Francisco area, not too far away, San Jose, around that area. Yeah, which is houses are expensive.
Everything in California is expensive. Doesn't matter where you're at. How expensive? I mean, it really is. It's not. It's one of the most expensive markets for homes in the whole country. So I mean, anything whether you can save, whether you can apply towards that is important. But like I said, I mean, we just don't want to see people get in their own way of achieving their goals, because sometimes people have a tendency to be. So, not saying this applies to Marvin, I'm speaking broadly.
Correct.
Like in general, based on like sometimes people can get in their own way and they can destruct a situation that's already in place for them to achieve. Sometimes it's easier to just keep it binary, but this is something we can talk about with him as we get closer to finishing them up.
Yes. So someone said 0 interest for 84 months and no payments for 90 days. I would never finance a vehicle for that long.
I don't think they go out for 7 years though. I mean, maybe they do now. I've seen everything possible.
I think so, Jay. I think I've seen some 84 months.
It may. I mean, it doesn't surprise me. Like I said, it's going to only get more accommodating too. So the good thing though in those situations though is even if you assume, it goes back to what I said earlier, if you understand the depreciation and you make 3 years worth of payments, whether you want to finance it for that long or not, you make 3 years worth of payments and none of it goes towards interest. And you should still be able to. No,
not interest, principal.
I'm sorry, you're right. Yeah, principal. If you make 3 years worth of principal payments, you're still going to stay out in front of the depreciation, and you're probably going to still have equity in the car, so you can get out from underneath it whenever you want, even if you don't want to run it for 7 years. Most people don't ride their car out to pay the whole loan off, right? It's just not that common. They typically roll it in and get another loan. I think the average score is like people hold their car 3-4 years, right? Typically.
Yeah.
So before they go in and get a new one, which obviously is not the normal to pay off the loan entirely. So with no interest, obviously you're avoiding that interest cost, 100% of your payments going towards the principal, which is going to accelerate the pay down, and as long as you're not rocking it, like we talked about in miles.
But I think people during these times, Jay, we get a lot of people buying used cars and paying them off because they don't know that what's going to happen. You might as well.
But not only that, but you can also, there's a lot more deal to be had with the used car because there's a certain minimum on the manufacturer gets. They don't have a ton of flex on the sale price of a new car, right? It's just not, because there's a manufacturer minimum they got to get on the car, and there's ways to make the numbers funny, but in reality, the manufacturer still has to get a certain amount of money. When they're selling a used car, in a lot of cases, that's them getting over on a consumer, right?
Yes.
They're giving them a trade-in number that's nonsense, right? And they have a lot more flexibility to resell that car in because they know what the cost base is, and it's not nearly as tight as the cost base is on a new car, right?
Correct.
I mean, it's a standard new car I'm talking. I'm not talking about like a Lamborghini or something like that. I'm talking about just your run-of-the-mill average car, right?
Yes.
So in most cases, there's a lot more negotiation on used cars, right? To be able to get the number down, to make it more accommodating, to get more sustainable terms. So obviously you're not getting paying 0% for 84 months and all that stuff in a lot of cases in those situations, but you will get cars cheaper, and I think as a result, obviously that'll, with at the right interest rate, that'll tie back to saving.
Correct. Okay, so Marvin says, me and my wife with doing a side hustle, making some extra cash. Our credit card is kind of high. Should I just ask for a couple thousand, but not too much? But still get a house? Okay, so they're trying to go and ask, they're maxed out on their credit card.
If he gets less money, if he borrows less and he uses it, is it going to lean on that income less? Yeah, theoretically, but at the same time, I mean, it all goes into we'd have to look at it. It's a difficult question to answer specifically with 100% conviction without looking at where your debt to income ratios are relative to what you're trying to buy, right?
Correct.
If you have room and that doesn't play into it, then I would say, no, you're fine. You know, if you're trying to buy a $600,000 house and you guys are at a 40% debt to income ratio with your income for that amount back down to the debts on your report, and this is only going to add a couple percent to it, then I would say, no, you're fine. It's not going to have any impact. It might sway the score a little bit, but at that point, it'll keep you in the low sevens rather than the mid sevens. In a worst case scenario, you'll be fine, right? But without knowing all that, it's difficult for me to give an exact number. I need to know more of those particulars to give you more of an understanding. And these are the things that we try to do with clients to get a better idea. It also gives us a better idea to give you the exactly right answer, right? Not just an opinion based on broad terms, to give you a specific answer to provide to you so that you have a specific answer you can lean on.
Correct. Well, and you don't know if it's going to be conventional or FHA either, Jay. So that
the debt to income ratio isn't going to deviate all that exponentially either way, right? So your debt to income ratio, depending on the product rate, may deviate between 50-55%, right? So whether it's an FHA or a conventional, is only going to be the score and what's on the report. But the debt to income ratio is going to be the same either way or very close to. So that won't deviate. The product that he picks isn't going to have. That's only going to change how the report needs to look, not the debt to income ratio. So that won't have any real bearing on being able to arrive at that number for me.
Okay, I have Tom Chambers who asked, does this apply to a used motorcycle as well as a new one? When we were talking about,
I don't know. It's a good question. I don't get that question a lot, and I don't know enough about motorcycles. I feel like.
Well, I asked him. He says a Harley. So Harleys could go $20,000-$30,000.
Yeah. I mean, I understand. I don't know how the depreciation works on a motorcycle. I don't know. I mean, I know they offer similar loans to auto loans, so I would think,
Well, they're paying what, $80, $120 a month for a motorcycle loan? I mean, it's something.
I think it goes higher than that. I mean, some of these Harleys are expensive.
Well, yeah, the Harleys are expensive. That is true.
Yeah.
They could go up to like $45,000. Right?
Yeah. So I mean, that's a car. So I mean, no, they're not cheap. But I mean, I would think it's probably comparable, probably very similar type situation. I just don't know how. I don't know I know with an auto it goes up to 100%. The bank will end up to 110% of the value of the vehicle. I know motorcycles are not booked like autos, right? They're more like
cars or something like that, like weekend things.
No. I'm talking from a lending perspective in the product, so it gets booked a little bit differently than the other ones would. But I would think, without getting too confusing, I would think it's probably almost identical. I just don't know 100% conviction how they work off of the lending side of it up to what percent. But I'm sure it's very close to the auto, and as a result, everything that I said is probably the same when it comes to autos. Are very close to motorcycles are very close to it.
Yeah, because if car loans are going down, I don't know. It could be either or, right? That the motorcycles are going up in sales or down in sales because there's.
No, I think he was. I mean, if I understood the question right, I think he was talking about the scenarios about moving negative equity into a new loan.
Okay.
You understand what I mean? Like I think that was what he was asking. Is it the same scenario when it comes to motorcycles? If I understood him correctly. So, and if that's the case, I would think so. Yeah, I would think it's the same dynamic.
But they got to sell too. They got a big motorcycle mall here in Jersey, in Belleville, New Jersey, and all you see is product outside when you pass by. there's motorcycles in boxes, like waterproof boxes, like mountains of bikes in the parking lot. Nothing is moving, Jay. And you see it more here, but in your state, you probably don't see that much. But there's a lot of people have motorcycles in Florida.
Yeah, I mean, but you definitely see it, but I feel like I think you see it more in Florida than you probably do. I don't. You see them, don't misunderstand me, but you don't. I feel like when I was younger, we used to see them a lot more. I used to see them on the street a lot more. In like 2000s, early 2000s, and the late 90s and stuff like that. You see people on motorcycles a lot more than you see it now. And I mean, look, it's indicative. Look at Harley. I mean, without getting into this too far, look at Harley Davidson. I mean, the stock is not even close to where it was before. I mean, the sales are so far down. They're having difficulty maintaining in this kind of an environment, and they're the benchmark in motorcycles, right? I mean, they're effectively the Rolex of motorcycles, right?
Yes.
So if they're having trouble selling, what do you think the Yamahas and the Kawasaki's and the crotch rockets, what do you think they're doing?
Yeah.
Like if the Bentley can't sell, you think the Kawasaki 700, 800 is selling? I mean, come on. I mean, it's not. So I mean, it's just a tough business. It's a tough business, and then you couple it with the fact that it's they're seeing autos have trouble selling. You have to figure that pressure is 10 times on a motorcycle company, trying to sell a motorcycle. Because that's an additional vehicle, right? That's not even your primary vehicle. They're having trouble selling primary vehicles. For most people, that's just a Harley or a motorcycle. It's just an auxiliary scenario. It's not your primary means of transportation. You know what I mean? So it's like a second home. So think how hard it is right now to sell second homes. It's not the right time.
Well, I don't know what's going to happen with the economy with people not flying, for one. People are going to want to vacation. So I don't know. Maybe RV rentals are going to be up. Maybe, other cars are going to be rented to drive around the country. I think that people are going to want to stay around.
I think what you said about the RV thing, I think that's a really valid point, and I think that's a legit. I mean, I think that's probably more what you're going to see. I think you're going to see a lot of people that are going to do their vacations in an RV, and that's my opinion. But I think it's very real because it doesn't necessarily have to be so expensive, and it eliminates the concern of a lot of the variables that come into play with the airlines and stuff like that, So, and the fact the airlines are doing absolutely nothing to accommodate, make any adjustments for they're doing nothing. I mean, they're making no adjustments because either A, they can't, or B, they're just saying that they're like restaurants and they can't make the money they need to make if they take out the middle seat or if they put CapEx into the flights and stuff like that to prevent any further stuff. So they're just they're resting on their laurals, and as a result, this is where we stand because they think the market's just going to naturally, come back to them.
But what is it that they did that they said something about they during all this time they were buying back their own stock, and as soon as everything hit the fan, they want to bail out too. But they were saying
that's not specific to them, but most of the reason why, I mean, not most of the reason, but I mean, a significant reason why you saw the pop-off top we had from 2016 into earlier this year was buybacks, right? So companies would go out and take on debt, or they would get the money from the tax savings from the tax that came out, and they would turn around and on dips when their stock dipped, they would buy it. They would use that money to buy their own stock. They would buy shares of stocks back, and that would drive the stock higher. That's why you saw a lot of stocks at these all-time highs that just kept doing it more, and they make money on those stock buybacks. And they profit from it because they buy their own stock and they buy it at a lower price, and by them buying and soaking up the sellers and moving it higher, they made money on that too, right? Problem is that, I mean, and that's great for investors. If you're an investor and you know that the company's there on down days and they're buying their own stock, obviously it's a vote of confidence. But more importantly, you have a buyer that's waiting in the wings to help soak up a lot of the sellers, right? So that the downside won't be as exponential as it would for somebody who's not buying back stock. Help to drive the stock prices high. You saw this industry-wide. This wasn't specific to just airlines. The problem is, and the argument is that the airlines have been bailed out like 50 times. So the argument is that, look, if you had money that you were getting from the government and you were making money hand over fist, you should have been stocking this money away because you should have known historically that every time we have a downturn in the economy, you guys are the first ones asking for a bailout, right?
Mm.
That's the argument, right? Like Apple does buybacks, Starbucks does buybacks. Both very strong stocks, both companies that make exponential amount of money. Nobody's saying anything to them because they can, right? Apple has like $300 billion in the bank, right? They buybacks for them are irrelevant. I mean, it helps us as investors, right? Get peace of mind, but for them, that's not a problem for them. The problem is when you have a company like the airlines that have historically had problems making money and cannot afford any kind of zigzag in the economy, and now they're doing buybacks with money they should be putting away, right? Or doing, saving for a rainy day and doing that over that period of time, and they're not doing it. That's where they're getting the pushback, and then they're asking for more bailout money, which a lot of people don't think they should. And I don't think they should either. I mean, you're sitting in a situation right now where they've made no adjustments. Every other business in America has made adjustments to their existing business model to adjust for whatever scenario is coming out of this. They've done nothing. They've done
And
nothing.
they cry.
Yeah, but I'm saying they've done nothing in the way of making adjustments to accommodate for this scenario, right? They've done nothing. They're not putting plexiglass between the seats.
Oh,
right?
correct.
They're not doing any of that. Not even that. How hard would that be to do? Put a plexiglass divider between the people, right? Just give them their own privacy so that the guy.
How are you gonna sit down, Jay? I mean, you don't fly anymore because you're a germaphobe.
I'm not a germaphobe, man. I'm just honestly, look.
You drove this time to Philly.
Yeah, because I wouldn't put my kids on a plane right now, but at the same time, I'm not a germaphobe. I'm just not an idiot either. So, I mean, every time I fly, you always leave with a cold. It's not as a result of just a coincidence. It's just because there's disgusting people that are.
We don't have time to get sick, Jay. With the amount of work we got, we can't.
No, I'm not. It wasn't even an option to get on a plane. It wasn't even an option. But the point I'm trying to make is even in a normal market, planes were disgusting germ pits, right? That's just a fact. Everybody understands that. Like I said before, it's why they came out with an over-the-counter thing called
Airborne. Correct.
It's like a Z-Pack and a vitamin, right? So that you go on there, you build up your immune system, so whatever you could potentially catch there, it blocks it, or it does it best, right?
Correct.
Now they've done nothing to rectify that. If you ever look at what few people are flying, they're wearing the mask. That's the only adjustment, and that's our adjustment. That's not their adjustment.
Well, there was a doctor that used to go on what's that show, Today Show in the morning, and he said he got into an airplane. He noticed the people were wearing masks. Everything was fine. Someone sneezed or did something. The next thing you know, he's in the hospital, got coronavirus, and then he said the virus went through his eyes. So what are you gonna do? You gotta wear glasses. You gotta wear a mask, or what else? You gotta have the separations in each plane.
There's just no viable answer. Even if they took measures, like I just said, and let's just say they put, there's plexiglass everywhere. I mean, you want to buy a company, find out who manufactures plexiglass, because I mean they're gonna be dead. I mean, there's so much plexiglass being manufactured.
You see right there, someone just asked. Off-topic question: will it be a good time to invest in airlines? Now, didn't Warren Buffett just came out of all the airlines?
He dumped everything. But I mean, look, everybody's investment scenario is different, and if you ask me my opinion, my personal opinion, correct, I wouldn't touch it until they give you some kind of an idea how they're going to change as a result of this. Otherwise, everybody knows how they feel about it, and they haven't made it, which is really unusual that they've made absolutely no effort. I mean, I've seen almost every CEO of the major airlines come on CNBC at some point in time over the last month, and none of them have come up with a solution on how they're going to change flying experience so that it can accommodate people's concerns. And until they do that, I don't see the stocks popping. I mean, they're treading water down where they're at. And I mean, obviously, we're going to need some kind of flying industry over the course of time. My concern is that over the course of time, if they don't make the necessary adjustments, you're going to see, rather than having 5 or 6 big carriers, we're gonna have 2 or 3, and they're gonna consolidate, and they're gonna consolidate. The ones that are most capitalized are gonna be the ones that can last the longest. And I think, I that's my personal opinion. I'm shocked that they haven't come up with a solution yet for, addressing this, because if they did it, people would feel so much more, especially Wall Street, people willing to buy those stock would be so much more comfortable with the idea if they saw a vision in place. And if you're the airline, I haven't the faintest idea what you the last 2.5 months. If you're only flying 20,000 people a day, what else are you doing? Your entire life should be centered around trying to come up with a solution. If you haven't come up with one positive solution, then you guys, it's like the guy, what's his name?
Warren Buffett.
Indian guy. He's a venture. He's a hedge fund manager, and he's actually really, really smart. He's from Silicon Valley. I can't remember his name. But he came out, and he was like, you should let him fail. Let him fail.
Yeah.
Letting an airline fail doesn't mean.
Oh, the billionaire guy.
Yeah, he was a billionaire.
Yeah.
He was like, let them fail. He goes, listen, if they fail, it doesn't mean they close. It doesn't mean it's over. It just means they have to go through bankruptcy proceeding, and maybe they need to go through that kind of a proceeding to start to take the situation seriously. They're obviously not doing anything. Not that I can see, and obviously I don't. Not on the board of directors, but I mean, publicly, you would think they would want to go out of their way to try and quell people's concerns.
Yes.
To try and. Even if it's not, even if it's just a thought, even if it's just a fleeting thought, just some kind of an idea that an investor or a consumer can wrap their brain around on how the airline industry is going to adjust over the course of time. Just give us something, right? Let us see the future, right? Give us a vision of what the future could look like. But instead, they keep harping on the fact that due to the lack of people willing to fly, you're going to get the privacy you want and the space that you want, so you don't have to worry about taking out the middle row. And they're not going to take out the middle row. And not that I think that's the solution anyway, but I'm just saying that, just that kind of ignorance to me, and public ignorance seems like they're just digging in. So I wouldn't, me personally, I wouldn't be buying right now until they come up with a really nice plan on how they're going to come back to life. And I don't know how anybody's going to really feel comfortable flying right now. I really don't, man. If somebody does, they're good for them. Maybe they know more than I do. I just, I got kids, and I'm not willing to put my kids at risk, much less myself and my wife. And I just think that's a risky environment right now.
The boats, the cruises.
Risky person.
The cruises.
Oh, the cruises. I didn't. Cruises have this cult-like following that I don't even understand.
Retirement people, but imagine you being retired. The next thing you know, you go on a boat and you catch corona, and that's it. You're gone.
Yeah, but hold on. You know what happened with that, right? Like when they were out and this coronavirus was kicking in, they didn't let them dock. They let them had to sit out in the boats and get treated like they were captives.
Yeah.
Like they weren't allowed to leave their rooms. They were getting their food slid to them under the doors. Yeah, there was people that were calling up like, yeah, we're out. They won't let us get off the boat. We're out here. One guy called in to CBC the one day on his phone on Skype.
No. You saw that in Florida because it happened in Florida. Over here, we didn't see that.
They were docking in Jersey.
I didn't get to see this. What? It had to be Bayonne.
I don't know, but they were docking, I believe, in Jersey. This is one of the first ones that came in when it all started. And they let them off the ship because they were concerned one of them may have it. And so what they did is they left them out there for, I want to say it was a week.
Yeah.
They couldn't leave their rooms. They were stuck in their rooms. They were calling in like they weren't being told what was going on. They couldn't get out of their rooms. They could, if anybody's, look, I've been on a cruise once, and the rooms are the size of a closet.
Oh, God.
I couldn't even imagine the average room being that size and having to be stuck in. I'm just saying that when you've seen the worst case scenario, and I would certainly think that that's one of the worst case scenarios when you get on a cruise, how could you go back knowing that there's a possibility something like that could happen again, Like that would be, but there's people, and the fact that there's people that are willing to do it, bless them. Like I said before when we talked about the real estate market.
Yeah.
There is a market. People are buying cruise tickets. People are buying plane tickets. People are buying houses right now. It is not, though, it's not January, though. It's not that volume. It's not that economy. That's not where we're at. There's still activity, yes. We're not at a complete standstill as a functioning economy, but it's nowhere near what it was. And I think it's going to be, knows how I feel about what I think is going to, how I think it's going to play out. I certainly hope, it's a soft landing, but I think, there's going to have to be shakeouts that come out of this.
Do you know, when some Fat Boy 50 asked, when a corporation filed bankruptcy, does it affect their credit rating as it would an individual person?
Are we talking about like a corporation
Like Hertz.
like Hertz?
Yeah, they have a credit rate. They got business credit.
So what
right?
happens is Hertz is a publicly traded company, so their debt gets graded because they get tranches of debt. They get bonds, right? They get convertible debt. They raise money in the private markets left and right? Like they have. I read the bankruptcy file, and they have like $24 billion of debt.
Whoa.
They have $25 billion worth of assets and $1 billion in the bank. So they're not quite insolvent yet relative to their filing, but they're right there, which is why they're filing it now. Now, Moody's and Standards & Poor's, which is S&P, ranks that debt.
Okay.
They give them a grade, right? Even the United States has a debt grade. That grade starts at AA, AAA,
Yes.
etc., depending on who the provider is. When they file for PK, obviously their debt becomes, because the market dictates it, right? The interest rate on borrowing for them goes up. It turns into junk status eventually, depending on the circumstance and how the market views it. I'm not saying they become junk status. I don't follow their bonds or anything like that, but this is typically what transpires when a company files for this kind of a situation, and then they got to reorganize the debts, and then they come out. And if they come out and their situation is actually sustainable, where it puts them in a position where, because a lot of times public companies, rather than fixing the problem where the wound is, they just keep kicking the can, right? So they raise more and more debt to pay, to service the old debt, right? And then you get to a point where you just can't. You hit a point in an economy like we've hit right now with them, where they can't raise any more money and they can't service their debt any longer, and they've run out of time, right? So now they have to go back and restructure. And sometimes when they can restructure and then come back out, if it's a sustainable situation relative to the amount of money that they can make in their present, sometimes that can get them back in a good position relatively quickly. It's not like the human being scenario, right? Okay. Nothing like that whatsoever, where you're kind of put in a penalty box, right?
Yes, for years.
Unless you get your credit clean for a period of time. Businesses, Wall Street is very forgiving because it's all based on the numbers, right? And Hertz has been in business for like 100 years. So, I mean, it's not as if they stopped being able to rent cars. That's not where the problem is. Most of the problems with these old companies that ends up happening is that their sales are sustainable, right? They've been sustainable. They've been increasing. That things look good. But when you look at it compared to the amount of debt that they start to accumulate over the course of time, that's where the problem comes in. You understand what I mean?
Yes.
You can make a certain amount of money, but when you're renting cars at an airport, you have a presence at every airport in America. How can you light a flame on that kind of a situation, right? You've already exhausted your presence. So, I mean, sure, there's odds and ends you can promotionally try and do it, but your income is your income at that point. Now the way to kind of get them back in a position of functionality is to get the debt down. And their debt, like I said, it was $25 billion. So,
whoa.
I mean, if they can work stuff out with their creditors and their debtors, then yeah, it'll come out in a much better situation, which I think will be more sustainable, and you'll see it respond. Now, it'll take a while, though, because a lot of those debtors and creditors, they don't want to bend over, It's not like, when somebody files a Chapter 7 personally, and the banks just are like, all right, whatever,
Yeah,
and
yeah.
And they realize that they're not going to be able to get anything anyway, and the individuals and so on. But these are different. When you're a company that has $25 billion or $26 billion in assets,
yes,
obviously you're a little bit different, right?
Correct.
And it becomes a situation where they want to try and get as close to the amount that they're owed on the dollar. So, no, I don't think that. That's not that I don't think it's not similar at all. Unfortunately, when you get to that size, obviously the smaller businesses, yes, it impacts them just as much as it would as a personal person. You know what I mean? Because in those situations, you don't have access to the credit markets. You don't have the same capitalization.
Yes.
You likely don't have the same level of collateral or creditor, experience, etc., or the relationships on the banking side, or the access to private capital. All of that stuff you don't have. So you leverage your personal credit tremendously, and as a result, if you run into a problem there, it limits you greatly as far as growing. So
you see how that question was answered? We talked about big business, and then we talk about small business and how it relates to you personally guaranteeing. But the thing about businesses and people who personally guarantee is what we see a lot more people going bankrupt personally than their business, because a lot of people, their business is how they make money. So they'll rather be late on their personal side than not late on whatever business side they're paying.
I think, broadly speaking, I don't think anybody wants to be late on anything if they can control it, right? I just think that, I do think, though, however, when it comes to the business side, I think that, not to tie everything back from earlier in the conversation, I think that the SBA disaster loans, if somebody got them and these PPP loans, they definitely are coming in hot, like heavy, like larger than they should be, and to the benefit of the business. You know what I mean? Now, granted, I submitted a lot of, good functioning businesses, so I wasn't, but they got more than the anticipation. You understand what I mean?
Yeah.
And which I think is awesome, and I think will help to stay or provide some liquidity, and provide them some much needed time in some cases to see if people are willing to spend. But we'll see what happens. I mean, I don't know how much time it's going to buy. I don't know how many people actually got it. I'm just speaking because I wanted to tie back from, I complained in the previous podcast about the fact that they weren't finally released and nobody really knew because there wasn't really any specifics. And now I can report some good news around, them closing and the process and the amounts and stuff like that. It was positive. I just think the one mark they missed was the timetable.
Well, I mean, we got a couple of economic topic questions answered by John. So this has been a great educational podcast right here. Some people didn't know about the bankruptcies with corporations, how that works pertaining to your personal, if you do it personally, and the Hertz evaluation with the bankruptcy as well. So thank you so much for this education on that.
Let me just say one thing real quick.
Yeah.
Just to expand, maybe it'll allow people to wrap their brain around it. When you're a publicly traded company, all that debt is on the business. So like the owner of that, like the CEO of that company, like for instance Hertz right now, the CEO of Hertz, he's not guaranteeing anything because that company has a 100-year history. It's everything is in the name of the business and the assets, and that business has legitimate assets. Believe it or not, those cars, that $24 billion worth of debt that they borrowed is levered against the vehicles that they own. That's how big the fleet they have is, right?
Whoa.
So it's not like a situation you can see on a smaller side, and I might have already talked about this, but in that situation, the individual that runs the company is guaranteeing it. On the side, that's, on the publicly traded companies and the larger companies that are collateralized, that have been in business and are large enough with the market cap and such, there's no personal guarantees there. It doesn't happen. It's all in the business. So there's no personal element there. It's related to the business, the functionality of the business, and all the other things we talked about earlier. So you kind of vacate and you take out the personal scenario entirely out of the equation. It's strictly on the commercial side. So maybe I'll give a little more clarity to what I said earlier, why you see such an exponential difference in the smaller businesses and the large, the publicly traded ones, other than just their access to capital.
Okay, well, we got it here. Hour 47 minutes, John. Thank you so much. Again, my people, this is, hey, happy Memorial Day. Happy Memorial Day, everyone. That was the first thing that I had to say, and that was the last thing that I'm saying. I'm sorry about that. Thank you for your service, those who serve. We actually got to help a lot of people who are out of the country, who are in the military. We got customers in Italy, right, Jay? Afghanistan, Bahrain. We got people in Japan who we've helped out, who are currently in the military, or they're just, out there on business, but they still want to come back to the United States with better credit. So there are some people who start with us, and it's not a problem. The only thing is that you need an address in the United States, correct, Jay?
I mean, believe it or not, they do honor the base addresses, like the APOs and stuff. But
even if it's a base over there in Italy,
it's easy. You mean like Willie?
Yeah, like Willie. Correct.
Yeah. So we would get it sent to his place in Chicago, and that's normally what we prefer to do, just to avoid. Because honestly, for mail to get international, it takes a lot longer, and it's just a lot higher probability of things getting lost that we don't want. So it's just easier doing it that way and just setting it up, because everybody comes back typically as a residence, whether it's their parents' residence or the family house or whatever. We just prefer to send it to their domestic address, right? And,
yes.
And most people have some address, whether it's theirs, their family, whatever, that they can send it to, that we can use as a point of reference.
Correct. Yeah, because I always saw a military address there, and I always said, listen, because the people who in Bahrain or Afghanistan or Saudi Arabia, they've lived, in Atlanta, they've lived in Louisiana, Florida. At least we got an address in the United States.
Yeah.
Okay.
it allows everything to flow a little smoother just because of the communication element of it. But I mean, look, a large majority of it's all done through the internet anyway. But there is times we need hard copies and stuff from the creditors and the bureaus, and that obviously helps to alleviate a lot of that.
Okay. All right. Anything else, Jay?
No, not at all. I think I know we started off with we try to get to the topics we place because they're important topics that people ask a lot about, and
Correct.
we feel like a lot of that knowledge can help to just further the knowledge, right? Because this is about trying to educate. And I know because we're getting a lot of positive feedback from people that are watching a lot of the podcasts from when we started to date. And I think, from what I'm being told, there's a lot of knowledge being, consumed, which I think is awesome. And I think it's great that people are taking the time to listen. I know they're long-winded, but they're long-winded for a reason. It's not because we're talking about nonsense. A lot of the answers that I give are long-winded because they provide detail that any level of education and understanding can make sense out of, right? And I try to be as specific as possible so that it adheres to every type of understanding, because some people may be somewhat knowledgeable fiscally and some people may have no knowledge fiscally. So if I get as detailed as possible, it's for the purposes of trying to cater to every single person that's listening so that they can understand exactly what we're trying to explain, regardless of how deep or in-depth the conversation really is. So I think it's awesome that people are taking the initiative and they're starting to learn, they're starting to get an idea of things. So we're going to try and do our best to stay on topic. Just understand, if we veer off topic, we talked about earlier, a lot of times it's going to tie back to a previous podcast that we've had or something else we've talked about, not to get off the original topic, but to really just continue it as a flow.
We got to stay up with the trend with the Rona, John. I mean, this is what's going on right now outside. I mean,
no, but that's what I'm saying. I like to tell people, when they've only watched one, I'm always like, listen, you should just start from the beginning. Doesn't mean you did binge it in one day, but start from the beginning and then follow it through, because then you'll have a much better understanding when you watch it or listen to the next one, right? And then the next one, because there's a lot of knowledge in each preceding one that will help catch you up on the next one coming forward, right?
Oh, yes.
It gives you a much better understanding. It also allows you to learn a lot of stuff in a short period of time, and then it allows you to ask questions going into the next one. So, and we always say, I always like to say when we wrap this up, if you enjoyed it, obviously please send this out to people that you think it'll help, because I think whether or not they start on the credit repair side, I think the education side, just knowing the rules of the game, I think can help people beneficially, whether they can use our service or not. Although we'd love to help them, but at the very least, if you can educate yourself, obviously knowledge is power. Everybody knows that, and it allows you to make the right decisions for yourself, whether you can afford the service or not, and you can make the right decisions for yourself in whatever current situation you're in if you know how the game is played, right? So definitely please send it over to people that you think you can benefit, because we want to get this knowledge out to as many people as possible.
Well, Curtis just says, great show. We talked about credit, auto, small business, corporate bankruptcy, collateral debt, etc. Oh man, I can't wait to ask you next week about how was the first week back in Philly, because
I think this will be cool. I think it'll be cool monitoring, because honestly, I really feel like the first thing we got back is we're about 4 or 6 weeks behind up here. So if that's the case, then I would think come beginning of, which is effectively what I was saying, that you would think somewhere around July is when you'll start to see people crawl out of their caves up here more aggressively and start. I don't think the masks are going anywhere, but at the same time, you'll start to see a little bit of dethaling and hopefully continue to move from there. But you just don't know. We'll have to see what happens and play it by ear. But if it's any indication of how Florida was, previously, and how it slowly has gotten to the point where it's at now, I think, human nature is human nature, and you can kind of measure human nature based on broad amount of people, in any area in a lot of cases. So I think it'll probably follow it relatively close, but you're right. We can definitely track it going forward and see how it plays out. I'll be interested to see myself.
Well, I know you, I think you like to chill sometimes in the Jersey Shore, right? You go to Wildwood or something?
Yeah, I like to go to Point Pleasant, but
Point Pleasant. Yeah, I go to Point Pleasant too. The only place that's open right now is Wildwood.
Yeah, I'm not going to Wildwood. See, ours is typically the South Jersey, right? But it takes forever to go to South Jersey, so we stopped going to South Jersey because you can get to Central Jersey, in
much quicker.
From Philly, I get there in an hour and 20 minutes. It would take me to go to Ocean City, which is, South Jersey point, the closest one, it takes me the same amount of time, and it's like 20 miles away. So I mean, I'm not sitting in traffic. I don't got the patience for that. So it honestly, it's a little more residential sometimes, more Point Pleasant, and I don't mind it. So yeah, I mean, I'm not going there anytime soon.
Yes.
Maybe before the summer lets out of things.
I go to the nude beach in Sandy Hook, the North Beach. That's where I go.
There you go. I mean, I don't know anything about that, but I go to the kids' beach. You know what I mean? I bring my kids with me, and that's where we, But I mean, look, the beaches at every Jersey Shore, like, I know it's off topic, but down in Florida's got some of the most beautiful beaches you ever see, right?
Yes.
It's like gorgeous. It's not ever crowded, ever. I mean, there's so many beaches, it's not ever crowded. The Jersey Shore beaches are like...
Oh, forget about it.
It's insane. It's insane. It's almost not fun to go to.
But what else do we have here, John? I mean, the water's dirty. We got the sun. We might as well be with the sun.
No. Listen, I understand people going to it, right? I'm saying that the whole dynamic around it is just, it's awful. Because, I mean, there's just too many people in this close proximity. But you already discussed the water and everything else. So
yes.
It's something that you take into consideration when you go. But you know what? Look, that's what we all grew up with, and that's what, in this area, and that's what you come to expect from this area. So it is what it is. It's not going to change, right? So you just take it for what it is and you enjoy the nostalgia at that point once you're there. I just think it's going to be a little while before I head back there, until I see some kind of consistency, just because it takes some patience to get up there to begin with, and people are acting crazy already. I'm not going to go sit up there when people are acting crazy.
I know, not wearing a mask and stuff. Well,
yeah, that's what I'm saying. I'm not, I mean, not even just that, just people with the crazy behaviors, but I mean, that too.
Well, it's Jersey Shore. Everybody goes to the Jersey Shore.
Yes, but sitting on the beach with a mask on too, that's just not my idea of fun. So, I mean, we'll see what happens, but I mean, it'll definitely be interesting, to be home and seeing how it opens back up here. I hope everything opens up nice and quick, but I think I got a pretty good read on how it's probably going to play out. I think it's probably going to take a good month for it to really start to dethaw and people start to come out.
People definitely appreciate your knowledge, Jay. So definitely.
It's my pleasure, man. I that's why we, if you remember going back, at least when we started doing these in December, we said, it's good to start opening up the transparency and letting people understand he's helping them, but also, use it as an opportunity to educate people too. And I think they work twofold. I think it's worked twofold, and I think it's helped a lot. And I'm really happy to be able to bestow a lot of the information. I look forward to giving more. The more in depth we can get, the more people follow, and the more they stay with it, and the more they understand what we're trying to say, the more in depth I can get with a lot of this stuff. And
the more questions you ask, my friends, the more John will be able to elaborate on it.
It's good because we're doing it in the right speed, right? A lot of this stuff, we're touching on topics a couple of times, but each time we're touching on it a little more depth. We talked about mortgages a couple different times. Each time we're talking a little more depth. We're using a lot of terms, that the income terms, radios, things like that people can now tie together that they may not even have a clue what it meant before. So things like this that are just soaking into their subconscious and into their brain without even realizing it, right? That they're learning just from listening more and more and more, which only help going forward, right?
Yes. All right, Jay, let me let you stop. It's already 2-hour mark. Thank you so much, and enjoy Philly, okay?
You got it. We'll talk.
Take care. Bye-bye. Well, see mi gente, that was John. Thank you so much. Listen, these topics that you guys have, that how we get topics is the situation that you got going on with your credit. And now we got to navigate and help you out. So not only are there a lot of similarities in every situation that people get, like there's a whole bunch of customers that come with, should I refinance or should I go and trade in my car? What's going to be best for me? Or should I finance a vehicle or should I lease a vehicle? Those are the things that a lot of business owners or regular people, they always ask questions. Of course, for business owners, it could be tax deductible, or if you've got a car and you're using it for work-related purposes, the mileage or the gas could be tax deductible. That could be another topic. But definitely all these topics are of us with a customer that is going through this right now, and we helping them navigate through it, and we answer their question. Therefore, you get to hear this question and you get to learn about it. So it's kind of like a forum where we have all these customers. They each have their issues that they want solved, and they share with us, and therefore we share with you, so that if you are in that situation, you kind of learn about it and you learn how to navigate through it. So I definitely appreciate you guys staying on. Thank you so much. It's 2 hours. You guys always are the best. Thank you to the people on Facebook. Thank you to the people on YouTube. And you already know, if you want to contact for credit repair, that's, text me your email address. I'll send you my how to start credit repair information. Go to the website, GizzyCredit.com. In order to get a quote, very easy. Just send me your username, your password, Experian.com. Make sure you're able to see your 3 bureaus, and send me over the username, password, and the security question with the answer and the PIN number. We'll try and log on, give you a quote, see if you can get started. But right now, let's go and enjoy the day and enjoy the rest of the week. A happy Memorial Day for all those who serve. I appreciate you. Thank you very much.
Hashtag GizzyCredit. Hashtag GizzyCredit. GizzyCredit. Anything you want, then you can get it. Don't be scammed, cause then you'll regret it. You no longer gotta look pathetic. Look pathetic. GizzyCredit.
Hey.
Anything you want, then you can get it.
Hey.
Don't be scared, cause then you'll regret it. You no longer gotta.
Thank you, YouTube. Thank you, Facebook. Bella Rain is in here. Bella Rain, come and enjoy. Come on, Mama.
You no longer gotta look pathetic. Look pathetic. Gizzy.
Here goes Bella Rain giving me.
GizzyCredit.
Go Bella, go Bella, go,
Hey,
go,
hey,
go,
hey,
go,
hey.
go Bella, go Bella, go, go.
Oh.
Go.
Let's go, Bella. Let's go, Bella. Here it goes.
Woo!
What you need is just a change of plans.
Miss Daddy.
Time is money.
See you later on Instagram. Peace out, my people. See you later. Take care. Oh.